Okay, so you did it. You bought your first crypto, you've watched the charts, felt the thrill, and now you're thinking, what's next? Trading, right? Well, hold on. Going from just buying crypto to actively trading it, it's like leveling up from playing checkers to 3D chess in the dark. The rules are different, the risks are way higher, and there are these hidden traps everywhere. And look, in this game, knowing the rules isn't just about making money, it's about not losing everything. So let's dive in.
And this probably sounds familiar, right? You see a price on the screen, you smash that buy button, but the price you actually get is different. Or you go to sell and bam, the market just seems to know and moves against you instantly. It's frustrating. It can feel like the whole thing is rigged. But here's the secret. It's not rigged. It just has a very specific set of rules. Rules that, frankly, most beginners get wiped out by because they never learn them. We're going to fix that today.
All right, so the very first choice you have to make as a trader is, where am I even going to do this? And listen, this isn't like picking between two different supermarkets. In the crypto world, you've got two completely different universes for trading, and the one you pick has huge consequences for your money, your security, and what you can even do.
So let's just boil this down to the main trade-off. A centralized exchange, what we call a CEX. You can think of it just like your bank. It's easy, it's fast, you log in, but you are fundamentally trusting that company to hold your money. A decentralized exchange, or a DEX, is the complete opposite. It's like being your own bank. You have full control. It's your wallet, your keys, your problem. That freedom means you are 100% responsible for keeping it safe.
So, what does this actually look like day to day? Well, with a CX, you're creating an account, you're uploading your ID, the whole verification dance, and they hold your crypto. The big scary thing here? The company itself could go bust or get hacked. Now with a DEX, you just connect your wallet. That's it. No sign up, no ID. You're in charge of your own keys. But now, the risk is different. It's about the tech. A bug in the smart contract, a clever scam token, and your funds could be gone. So, here's the simple way to think about it. CXs are awesome for getting started and for quick, easy trades. DEXs? That's your gateway to the Wild West of brand new tokens and DeFi.
Okay, so you've picked your battleground, CX or DEX. But now we get to the really sneaky part. The next big thing that trips everyone up is understanding why the price you see is almost never the price you get. There are these invisible costs, kind of like taxes, built right into the system.
And this all kicks off with one core concept: liquidity. The easiest way to picture it is like a body of water. A market with high liquidity, like Bitcoin, is a deep, vast ocean. You can drop a massive trade into it like a battleship, and the water level barely moves. But a market with low liquidity, maybe for some brand new obscure coin, that's a tiny puddle. You toss in one small pebble, one small trade, and the water goes everywhere. The price just explodes. The very first hidden cost that gets you every single time is something called the bid-ask spread. You'll see two prices: the bid, which is the highest someone is willing to buy for, and the ask, the lowest someone is willing to sell for. That little gap between them, that's the spread. And when you just hit buy, you're always buying at that higher ask price. When you hit sell, you're selling at the lower bid price. What does that mean? It means every trade you make starts off as a tiny loser, right from the get-go. And the wider that spread is, the deeper the hole you have to climb out of to make a profit.
And that leads directly to our next hidden cost, which is called slippage. This is what happens when your order is just too big for the current best price. Imagine it like this. You want to buy 1,000 coins. The first 100 are available at, say, $1, so your order grabs those. But there are no more at that price, so it has to go up to the next level. Maybe the next few hundred are at $1.01. Your order eats those up too. And it keeps climbing up the price ladder until your entire 1,000-coin order is full. The result? Your average price ends up being way higher than that $1 price you first saw. That difference? That's slippage.
So, you see? The final price you pay is never, ever just that big number you see on the screen. It's this whole cocktail of things: the price you were quoted, the bid-ask spread you had to cross, the slippage your own order created, and of course, the fees the exchange tacks on. It adds up fast.
Okay, so now that you know about all these hidden costs trying to chip away at your money, how do you actually fight back? How do you take back control? Well, you use the right tools. And in trading, your tools are your order types. They let you tell the market exactly how you want to buy and sell.
Think of this as your basic trading toolkit. First up, you've got the market order. This is the big red go button. It basically screams, get me in or out right now at whatever the best price is. It's super fast, you're guaranteed to get your trade done, but this is how you get wrecked by slippage. Then you have the limit order. This is your precision tool. It says, hey, I'm only buying if the price is X or lower, or I'm only selling if the price is Y or higher. You get complete control over your price. The only catch? The price might just run away from you and your order never gets filled. And finally, the stop order. This is your safety net. It's a preset trigger that gets you out of a trade automatically if things start going south.
And even with stop orders, you've got this critical choice to make. You have a stop market order, which is basically yelling, "The price hit my panic point, get me out now, I don't care what the price is." It gives you certainty that you'll get out. Then there's the stop limit order. This one's a little more composed. It says, "Okay, get me out, but I'm not willing to accept a terrible price." So you get more control, but there's a real danger that in a massive crash, the price just gaps right past your limit and you're left holding the bag. It's a classic battle, certainty versus control.
All right, we've gone over the mechanics, we've gone over the tools. Now, we have to talk about the big one. The single, fastest, most surefire way that beginners absolutely destroy their accounts. We need to talk about the trap of leverage.
You'll see this number plastered everywhere. 10x, 20x, 50x, even 100x leverage. It's marketed as this incredible shortcut to getting rich quick. Trust me, it's almost always a shortcut straight to zero.
So what is it, really? Simply put, you're borrowing the exchange's money to make a much bigger bet. With 10x leverage, you put down $100, but you get to trade with 1,000. Sounds great, right? If the price moves up just 10%, your $1,000 position makes $100. You just doubled your own money. Incredible. But here's the dark side. If the price goes down just 10%, you lose $100. And that's it. Your entire initial $100 is completely gone.
And that brings us to the most brutal word in trading, liquidation. This is not you deciding to close your trade. This is the exchange's computer system stepping in and force closing your position because your losses got too big. It's an automated game over. They take your initial money to pay back the loan they gave you, and you are left with nothing. There are no do-overs.
And here's why leverage in crypto is playing with fire. First, the volatility is just insane. Prices can whip around so violently that a single sudden price drop, a flash crash, can liquidate you in the blink of an eye. And what's even crazier is something called a liquidation cascade. That's when a bunch of people get liquidated at once, which forces more selling, which pushes the price down even more, which triggers more liquidations. It's a death spiral. You can literally get wiped out before you can even click a button.
Okay, the last piece of this survival guide. And it's another one of those hidden dangers for beginners. Fees. They look so small, right? A fraction of a percent here, a few dollars there. But they're like a constant, silent leak in your account, slowly draining your profits and your capital over time.
And you've got to understand, it's never just a fee. There's a whole family of them. You've got your standard trading fees, of course. If you're on a DEX, you're paying network gas fees. If you want to move your money out, there's a withdrawal fee. And if you're using leverage, oh yeah, there are funding fees for that too. You have to be aware of the entire cost structure.
So let's break these down real quick. On a CX, you'll hear about maker and taker fees. Pro tip, maker fees from using limit orders are almost always cheaper than taker fees from market orders. On a DEX, you're paying two things, a swap fee that goes to the people providing liquidity and a gas fee that goes to the network itself. And that last one, funding fees for leverage, watch out. They can hit you every few hours. This means you can be slowly losing money even if the price of your asset is going absolutely nowhere.
So let's wrap this all up into a simple set of survival rules. 1. Know your platform. SEX for easy on-ramps, DEX for new stuff, but understand the risks of both. 2. Low liquidity equals high danger. Always check it before you jump in. 3. Use limit orders. They're your best friend for controlling your price. Use market orders very, very carefully. 4. Just don't touch leverage, at least not until you could teach a class on liquidation risk. And 5. Fees are real. Account for every single one of them. Trading, gas, withdrawal, all of it.
So there you have it. We've pulled back the curtain. Slippage, liquidity, order types, liquidation, fees. These aren't opinions. These are the fundamental rules of the market. And the market is a brutal, unforgiving place. It doesn't care if you're new. It doesn't care if you don't know the rules. So the real question isn't whether you understand this stuff now. It's whether you have the discipline to actually follow the rules when your money is on the line.